Here's what should make every investor nervous. The US stock market is sitting at a CAPE ratio of 40. It is the second highest level in 150 years. The only time that it's ever been this high before was March 2000, the dot-com bubble peak, and we all know how that ended. The Nasdaq fell 78%. $5 trillion erased completely, and it took 15 years just to break even. But it's not just about the CAPE ratio. The Buffett indicator just hit 225%. That is an all-time high. Even Warren Buffett's favorite valuation metric is screaming expensive. So the question here isn't, are we expensive? Because we are. The real question is, are we at the peak? And even more importantly, what should you actually do about it? I spent 18 years with banks and hedge funds in New York and London. But today, I help high net worth individuals and their families here in Ireland. These families with meaningful exposure through their pensions and investments. So today, I'll show you whether the AI boom is real, what's driving these valuations, and what you need to do today to protect your wealth. But first, let's talk about the problem that nobody sees. Everybody says the same thing. It's different this time because of AI. The CEOs are calling it a form of revolution. And yes, these companies are profitable, so this is not like 2000 in that sense. That part is different. But here's the structural problem almost no one understands. These aren't independent companies creating independent value. These are part of a circular ecosystem. Each company's growth depends on the other spending, and that creates a vulnerability for investors, and we are missing this entirely. Let me show you the money flow. A few years ago, no one outside of engineering talked about GPUs. Today, GPUs are the currency that are driving financial markets, and Nvidia is at the top of the food chain. Nvidia sells these chips to Microsoft, Google, Amazon, Oracle, and OpenAI. Now what happens? Microsoft buys Nvidia chips. Microsoft invests 13 billion euro in OpenAI. OpenAI uses Microsoft Azure exclusively, so it pays Microsoft billions in cloud fees. But Microsoft also owns 27% of OpenAI. Oracle buys Nvidia chips. It builds the data centers. It partners with OpenAI. Google, Meta, Amazon, they're all part of the story. Buying Nvidia chips, buying AI models, selling cloud back to each other. Even Intel, with a huge Irish presence, is in the mix. Recently, Nvidia bought a percentage of Intel. Former chip leader is now lagging, and Nvidia just invested $5 billion into Intel stock. This ecosystem is big and powerful, but it's also deeply interconnected. Now, let's follow the money through the loop. Microsoft invests $13 billion in OpenAI. OpenAI spends $7 billion back on Microsoft Cloud. Microsoft books that as revenue, then uses that revenue to justify buying more Nvidia chips. Nvidia's earnings explode. Stock price soars. Nvidia buys cloud services from Amazon, Microsoft, and Oracle, and they book that as revenue. Wall Street celebrates AI growth across all these companies, but the question is this real economic growth or just big tech moving big money in circles? The thing is, we have seen this movie before. During the dot-com bubble, telecoms bought equipment from Cisco using a concept called vendor financing. Cisco booked it as revenue, telecoms companies booked it as investment, analysts celebrated both, but when the music stopped, telecoms companies went bankrupt. Cisco fell 89%. It was real products, it was real revenue, they were real customers, but the model wasn't sustainable. So let's analyze this properly and avoid the mistake investors made back in the dot-com bubble. Now, the thing is, when most investors hear this, they make one of two mistakes. Mistake number one is panic. They sell everything. They're trying to time the top. This destroys more wealth than crashes. The second mistake is they dismiss all concerns. Stocks always go up. Don't fight the Fed. They stay blindly fully invested in the most expensive segments of the market. Both these approaches are wrong. We'll show you how, and we'll show you what you should do instead shortly. The first and most important institutional metric is called equity risk premium. This tells us something simple but crucial. Are stocks offering enough extra return over bonds to justify the extra risk of holding a stock? Let's break it down clearly. Stocks have earnings, bonds pay interest. The equity risk premium compares the two. It answers one simple question. Am I being compensated for taking the equity risk? Here's a simple math. The S&P 500 trades at 21 times its forward earnings. That's an earnings yield of 4.8%. But today, the US Treasury 10-year Treasury yields at 4.5%. The difference, 0.3%. That's essentially literally nothing. Historically, investors demanded 3 or 4% spread to even hold equity risk. Today, it's just 0.3%. So unless earnings grow significantly and grow fast, stocks are not offering much compensation for this risk. Now, this doesn't guarantee a crash, but it does tell us something. When equity risk premium is this low, future returns are usually pretty weak, and market corrections become far more likely. Next up is the CAPE ratio. It stands for the Cyclical Adjusted Price to Earnings ratio. It was created by the Nobel laureate Robert Shiller. And here's what the CAPE ratio actually does. It smooths out short-term noise by using a 10-year inflation-adjusted earnings. Why? Because earnings spike in booms and they collapse in recessions. The CAPE ratio gives us a truer picture of a long-term valuation anchor. So here's the numbers. The historical average is 17. Today, it's 40. For comparison, during the dot-com, it was 44. Before the Great Depression, it was 33. Before the global financial crisis, 2008, it was 27. We are now at the second highest valuation in 150 years. More important, a high CAPE ratio does not predict a crash. It predicts low long-term returns. When the CAPE ratio was 44 in 2000, the next decade returned basically zero. When CAPE was 15 in 2009, the next decade returned 15% per year. 40 today, the long-term expected return at 3 to 5% a year is barely beating inflation. Now, the most quietly dangerous signal is concentration. The Magnificent Seven, remember Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla are 33% of the entire S&P 500 and 25% of its earnings. But here's the real danger. These companies rely on each other for growth. About 18% of their revenues comes from within inside that circle of the Magnificent Seven. Remember, we've talked about this. Microsoft owns a large portion of OpenAI. OpenAI buys cloud from Microsoft. Nvidia sells chips to all of them. They all depend on each other's spending. It's a self-reinforcing loop. If one company slows capital spending, the entire system was going to feel it. So now let's say we removed the Magnificent Seven from the S&P 500. The equal-weighted S&P 500 is still below the 2021 high. Those small caps at a 5-year low relative to large caps. International stocks, they're the cheapest relative to the US stocks that have been in 20 years. So the world isn't overvalued. The risk is concentrated in the US mega cap stocks like the Magnificent Seven. This creates 3 dangers. 1, single point of failure. 1 miss and the entire market could wobble. 2, the circular revenue loops. Spending flywheel can go in reverse just as fast as it accelerates. And the 3rd is the passive fund amplification. Index funds own a 1/3 of these stocks by default. If investors redeem, index funds must sell the most expensive stocks first. This is why corrections can be sharp and violent. So yes, valuations are stretched, the market is narrow, and parts of the AI ecosystem are behaving like a bubble. But here's the critical thing you need to understand. Knowing valuations are high does not tell you when the correction will happen or how big it's going to be, or what will even trigger it for that matter. And this is where most investors make the biggest mistake. They hear the word overvalued, bubble-like behavior, and they think the answer is simple. Sell everything, go to cash, do it now. But that instinct, that urge to time the top of the market, that has destroyed more wealth than any market crash in history. Because the moment you try to time the market, you step into a game that even the best professional investors in the world cannot win consistently. And the math behind it is brutal. So let me show you how. Take a simple example. You invest $10,000 in S&P 500 and you stay fully invested for 20 years. That will become $65,000. Now watch what just happens if you miss just the 10 best days. Out of more than 5,000 trading days, your 65,000 becomes just 32,000. Your return is cut in half. But if you miss the top 20 best days, you're left with just 18,000. That barely beats inflation. Here's the kicker. 6 of the 10 best trading days usually happen between the 2 weeks of the worst days, meaning that the biggest rallies actually happen when fear is at its peak and when everybody else is selling, when it feels terrifying. I want you to think back to COVID, back in 2020. The market bottomed on March 23rd. Daily deaths were still rising. Fear was everywhere. But by the time the all clear came, the market had already surged 50%. There was no obvious re-entry point. There was no bell to tell you to get back in because markets move before the headlines do. Just look at the dot-com crash. The Nasdaq peaked in March 2000. just above 5,000. By October 2002, it was 1,008, a 78% collapse. Investors who sold in 2000 faced one brutal question. So when do I get back in? 2003? Too risky. The Iraq war had started. 2004, the market had already been up 50%. 2006 and 7, that still felt pretty expensive. Okay, but then 2008 hit and they sold again. By contrast, investors who had stayed the course and kept contributing every month or every year were buying shares at 60, 70, and possibly even 80% discounts. Contributions made in 2002 delivered over 400% returns over the next decade. Why? Because they invested when it felt terrifying and let compounding do its work. That's the difference. Timing the market avoids pain in the short term, but destroys wealth in the long term. Time in the market captures both crashes and recoveries, and that's where the real wealth is built. I've worked in a hedge fund where they have every single advantage possible. Direct access to the world's CEOs, real-time market data, PhDs in economists and quants, billion-dollar research budgets, and still, we couldn't consistently time the market. Why? Because markets are forward-looking. They price in Fed cuts before they actually happen. They price in recessions before they're actually declared. They react before CNBC or Bloomberg or these news agencies have the news that you're listening to. Because by the time that you've heard the news, the market's already moved and you're too late to the game. There's a famous saying in investing, this time it's different. These are four of the most dangerous words in investing. But in this case, a few things are actually different. The first is Fed policy. 2000, the Fed raised rates from 4.75% to 6.5% and popped the bubble. In 2025, Fed is cutting rates. It went from 5.5 and downward trending now to about 4.5%. That will support these valuations. The second is cash generation. Dot-com companies were burning through cash and they were heading for bankruptcy. Whereas today, the Magnificent Seven, they generate over $200 billion a year in free cash flow. These aren't hopes and dreams. These are fortresses, cash-generating machines. But here's what hasn't changed. Market concentration is still extreme. The tech enthusiasm is still dangerous. And the circular dependencies are still fragile. Maybe even more fragile than they were in 2000. So, what should you actually do? Now, let's move to a framework that you can use. This is, in theory, this is what we do every day for families who have significant portions of their money invested in the market. Real money, real consequences, and here are 5 adjustments that work in all market environments. These are grounded in risk tolerance, risk capacity, and time horizon. The 3 core principles, plus we add in the risk premium. So here's how professionals think about it. The first adjustment is small tilts, not total exits. Say your long-term allocation is 70% equities. The market looks stretched. Dial that back to 65%, maybe 63%, but don't completely slash it by 50%. And definitely not cashing out. From 2017 to 2021, markets looked expensive every year, but they still delivered 100% plus gains. Clients who went to cash, they missed all of that growth. So small tilts respect the risk tolerance and your risk capacity without betting your future on timing. The second adjustment is geography diversification. Look at valuations today. So US large caps are 21 times earnings. In Europe, they're 13 times, whereas emerging markets are 11 and small cap stocks are about 12 times earnings. That is a huge spread. Now, we're not abandoning the US by any means, but allocating 25 to 30% outside the US will add bounce to your portfolio. In the 2022 crash, international stocks fared much better. This is about assessing new risk premiums and reducing your dependency on one geography, which in this case would be the US market. Adjustment 3 is factor tilts. Mega cap growth trades are around 30 times earnings today, where small caps, they're more like 12 times earnings. That is a massive gap, and it also creates an opportunity. We tilt 10% of portfolios towards value stocks that are cheap cash generating companies, quality stocks that have stable earnings, high return on equity and low debt, and also equal weight, reducing the exposure to the Magnificent Seven. This isn't about avoiding growth, it's about rebalancing better towards the right level of risk premium. Adjustment 4 is never stop contributing. This is the most important principle of all. Automatic monthly or frequent contributions is key. Never stop, ever. In 2008 and 9, clients who kept contributing through the S&P 500 at 700. Today, it's over 600. That is 8.5 times growth on money invested in the worst environment. This isn't timing, this is time horizon, and it's about having discipline When it feels scary to invest, that is usually exactly when it pays the most. Adjustment 5, time horizon trumps everything. You need the money in 2 years. You lack the risk capacity. You need to stay conservative. But if you need the money in 10 years plus, stay invested. Let volatility work for you, because over every 20-year period for the last 150 years, stocks have beat inflation, even through times such as the Great Depression, World War II, the 1970s inflation shock. Time horizon will win. Here is an investing framework that you can use. It's built around your risk tolerance, your risk capacity, your time horizon, and also the pursuit of the appropriate level of risk premium. When valuations are high, reduce equity exposure by 5 or 10%, not 50%. Add 20 to 30% international diversification, and tilt 10 to 15 to value or small cap and look for quality. Keep contributing automatically. Do not try and time the bottom. When valuations are fair, stick to your strategic allocation. Rebalance annually and ignore the headlines. When valuations are cheap, like say March 2022, increase your equity exposure if your risk capacity allows you to do so. Deploy your reserve cash if appropriate. This is where generational wealth is built. When others are afraid, you have to lean in. Look, markets are expensive. The circular dependencies in the top companies are real. Concentration risk is real. But here's what 20 years of finance has taught me. Knowing markets are expensive does not tell you when they will correct or by how much. That's why professionals don't try and time the market. We position, we adjust gradually, we diversify across what we cannot predict, we stay disciplined, and when emotions scream to do the opposite, that is the real secret. Now, check out my next video, how to pick the right index fund in Ireland. Now, in this video, I'm going to break you down the origin of index funds, what to look out for in a UCITS fund, the tax traps in Ireland, and my recommended funds on exactly which ones I'm buying today. This video cuts through all the noise and gives you a simple framework that works for Irish investors today.